All right, welcome in, everyone. Today we're doing a deep dive on a true classic, The Intelligent Investor by Benjamin Graham.
A fantastic choice. This one's packed with timeless wisdom.
It really is. Think of it as like our guide to navigating the wild world of investing.
Absolutely. And what's interesting is the book doesn't assume you need to be some kind of, genius to be a successful investor.
Right, right. It's not all about like having a sky-high IQ.
Exactly. Graham actually says it's more about temperament, your ability to stay cool under pressure, think for yourself, and not get swept up in all the hype and the noise.
So like even Sir Isaac Newton, the guy who basically figured out gravity, could mess up investing. Because the book tells this crazy story about him losing a fortune in the South Sea bubble.
Precisely. Even the brightest minds can fall prey to market mania if they let emotions take over.
It's like emotions can cloud your judgment no matter how smart you are.
Exactly. And Graham's point is that avoiding those big losses is just as crucial as chasing the big wins.
I mean, that makes sense. You could be right about a company's future. But if you overpay at the start, well, you've already kind of shot yourself in the foot, haven't you?
You've hit the nail on the head. It's not just about being smart, it's about being disciplined.
Which, brings me to something that really surprised me in the book. Graham never actually mentions age when he talks about how you should divide your money between stocks and bonds.
It's true. A lot of the conventional wisdom out there says, oh, you're young, you can take more risk, put most of your money in stocks. But Graham kind of throws that out the window.
He does. So it's not as simple as just plugging your age into some formula.
Nope. He says your ideal asset allocation depends more on your individual personality and your circumstances.
So instead of just following some generic rule, you have to really know yourself as an investor.
That's the key. It's all about self-awareness.
Okay, but how would someone even go about, like, figuring that out? How much risk they're comfortable with?
That's a great question. It involves some honest self-reflection. How comfortable are you with the ups and downs? How much time and energy can you actually devote to managing your investments? Are you the type who gets easily swayed by the news headlines or those market swings?
Right, right. It's easy to get caught up in the frenzy.
Exactly. So answering these questions honestly can really help you create a strategy that aligns with your temperament and your goals.
Got it. Self-awareness is key. Now, there's this whole concept of Mr. Market in the book, which I found super intriguing.
Ah, yes. Mr. Market?
It's like this fictional character that represents the stock market, right?
Precisely. It's this brilliant analogy that Graham uses to illustrate how irrational and emotionally driven the market can be.
Okay, so paint me a picture. What's Mr. Market like?
All right, imagine this. Mr. Market shows up at your doorstep every single day offering to buy or sell you shares of your stocks.
That's kind of exhausting, to be honest. Like, who
Yeah.
needs that kind of drama?
Well, exactly. And that's the point. Mr. Market, he's incredibly moody.
Moody.
Oh, yeah. Some days he's super optimistic, offering you sky-high prices for your shares. Other days he's all gloomy and pessimistic, just wants to buy them for a pittance.
So he's unpredictable.
Totally. And his offers often have nothing to do with the true value of the businesses you own. It's all based on his current mood swings.
That is kind of terrifying, actually. I mean, how are you supposed to make rational decisions with all that craziness going on?
Well, the trick is to not let Mr. Market's emotions dictate your actions. You got to use his erratic behavior to your advantage.
You like, when he's feeling down, you buy low.
Exactly. When he's overly pessimistic, offering to buy your shares on the cheap, that's when you swoop in.
And when he's manic and wants to pay top dollar?
You sell. You
Oh.
take advantage of those inflated prices.
So you're basically using his emotional roller coaster to your benefit.
Precisely. That's the art of it.
I'm starting to see why Graham called it intelligent investing. It's like a whole different way of thinking about the market.
Absolutely. Recognizing that the market's often driven by sentiment rather than logic, that's a huge advantage.
It is. Allows you to, exploit those opportunities and avoid getting swept up in those short-term swings. This is really eye-opening stuff. Okay, I'm ready to learn more. What other tools or concepts does Graham give us to navigate this crazy Mr. Market?
One of the most fundamental things he talks about is this idea of a margin of safety. It's like building a buffer zone into your investments.
Okay, that sounds interesting. A buffer zone to protect you from what exactly?
From Mr. Market's mood swings and, just all the uncertainty of the future in general.
All right, so break this down for me. What is this margin of safety thing all about?
Okay, so in the simplest terms, it means buying assets for significantly less than their true worth.
So like finding a good deal.
Exactly. Think of it like snagging a designer dress at a clearance sale. You're
Yeah.
getting that same quality, but for a fraction of the price, right?
Makes sense. So even if the price drops later, you're not losing as much because you got it on sale in the first place.
Exactly. It's
Hmm.
like having that built-in cushion to protect you from losses. And
Okay.
applying this to investing, it means being really careful about how much you pay for a stock.
Right.
You
Yeah.
want to make sure you're getting a bargain relative to what that underlying business is actually worth.
So how do you actually figure out what a company is like truly worth? That seems kind of tricky.
Yeah, it definitely requires some research and analysis. You got to dig into their financial statements, understand their competitive landscape, and make some educated guesses about their future earnings.
So you're not just throwing darts at a board.
No, it's not an exact science by any means, but the goal is to come up with a conservative estimate of what that business is worth, and then only buy it if the market price is, significantly lower.
Okay, so I see how these pieces are fitting together. It's not about just chasing the hottest stock or trying to predict the next big thing. You're waiting for those moments when Mr. Market throws a tantrum and gives you a great company at a bargain price.
You got it. Patience is key.
That's pretty cool. And that brings us to another important distinction Graham makes, right? Growth investing versus value investing.
Absolutely. Two very different approaches.
Okay, so let's unpack these a little bit. I hear those terms thrown around all the time, but I'm not sure I totally get the difference.
Well, growth investing focuses on, companies that are expected to grow at a rapid pace. Think of your tech darlings, the disruptors, the ones with those sky high valuations because everyone's betting on their future potential.
Right, those companies everyone's always buzzing about.
Mhm.
But Graham seemed a little cautious about those, didn't he?
He was. He pointed out that all the excitement surrounding those high growth companies can lead to inflated prices.
So it's risky.
It creates a lot of risk because if the company doesn't live up to those lofty expectations, well, the stock price can come crashing down pretty quickly.
Ouch. Okay, so what's the alternative then?
Value investing. That's all about finding those undervalued companies, the
Mhm.
ones that are maybe overlooked or misunderstood by the market. They might not be the flashiest or the fastest growing, but they have solid fundamentals, a history of profitability. And they often trade at a price that's significantly lower than what they're actually worth.
So it's like finding those hidden gems that everyone else is ignoring.
Exactly. Graham believed that by focusing on these undervalued companies, investors could achieve better returns over the long run while taking on less risk.
Makes sense. It's not about finding the next Amazon or Tesla.
Nope.
It's about buying good businesses at good prices and letting time work its magic.
Exactly. Buy right, sit tight.
Love it.
Okay.
Okay, so we've got Mr. Market, the margin of safety, the value investing mindset.
Mm.
But did he actually walk the walk? Did he give any real world examples of how these principles work in practice?
Oh, absolutely. The book is full of fascinating case studies,
Oh, perfect.
success stories, and cautionary tales. One company he highlighted as a prime example of his approach was IBM.
Ah, IBM, a true classic. So what made them such a good investment in Graham's eyes?
Well, back in the day, IBM was this, innovative, rapidly growing company, just dominating the tech landscape.
They were huge.
Huge. But unlike a lot of those hyped up growth stocks, IBM was also generating consistent profits and had a rock solid financial position.
So they had like substance behind all the hype.
Exactly. And Graham recognized that. He saw that IBM was not only growing, but also trading at a reasonable price
Wow.
relative to its earnings and assets.
Okay.
It was a classic example of a high quality company available at a discount,
Hmm.
offering that precious margin of safety.
So even when investing in a growth company, Graham was still looking for that value and that margin of safety.
Absolutely. Now, on the flip side, he also analyzed cases like Texas Instruments, which was another, tech darling at the time.
Okay, so what happened there? Did things go south?
Well, Texas Instruments did experience some incredible growth, but the problem was the stock price shot up so high that it became completely disconnected from its actual earnings.
So it was like the expectations got way ahead of reality.
Exactly. It was a classic case of the market getting a little too excited, driving that price way beyond what the company's, what its fundamentals could justify.
So even a company with great potential can be a bad investment if its price gets too inflated.
Precisely. It's a classic example of what Graham warned against. Overpaying for that growth can lead to some significant losses, even if the company itself is doing well.
This is eye-opening stuff. Seems like Graham was really good at spotting those situations where the market was like getting carried away with emotion.
He was. And he cautioned investors to be wary of those situations and to always stick to their principles.
Always stick to your principles.
Yeah.
Solid advice. Okay, what about some of those cautionary tales? Did he highlight any companies that really showed the dangers of ignoring his advice?
Oh, he did. One example is Realty Equities. It was a real estate investment trust that initially seemed really attractive to a lot of investors.
Okay, what made them so appealing?
Well, they were boasting these impressive growth rates, paying high dividends, and they seemed to be riding this wave of a booming real estate market.
So on the surface, they look like a winner.
Exactly. But when Graham dug a little deeper, he found a very different story. The company was heavily reliant on debt to fuel its growth. And their reported earnings were, let's just say, they were inflated due to some questionable accounting practices.
So the numbers weren't telling the whole story. Nope, they weren't. And eventually the truth came out. Realty Equities' earnings collapsed, the stock price plummeted, and all those investors who had bought into the hype were, they were left with some pretty significant losses.
That's a rough lesson to learn. It seems like those situations where a company looks too good to be true often are.
They often are. And Graham's analysis of Realty Equities really highlights the importance of, looking beyond those surface numbers, understanding a company's, their true financial health, and being skeptical of those overly optimistic projections.
So don't just follow the crowd blindly or get caught up in all the hype, right?
Right.
You got to do your own research, make sure the fundamentals are solid.
Due diligence is key. Now, another cautionary tale Graham looks at is AAA enterprises. They were riding that wave of the franchising craze back then.
Franchising, yeah, that's still a big thing today. What went wrong with AAA enterprises? Well, they went public with very little substance behind their business model. Essentially, they were selling franchises without any real track record or a proven concept.
So it was all smoke and mirrors.
Pretty much. And despite being backed by some big-name investment banks, the company quickly filed for bankruptcy, leaving investors with, heavy losses.
Wow. So even if a company has, fancy backing, it doesn't mean it's a guaranteed success.
Definitely not. And this case just reinforces that need to look beyond the hype, the big names, all the flashy marketing. Focus on understanding the business itself, its competitive landscape and its true potential for creating value over the long term.
This is incredibly insightful. I'm sure our listeners are soaking it all in. But before we wrap things up, I have one more question. We've been exploring Graham's wisdom from, way back in the 1940s and 50s. How do these principles apply to today's crazy world of investing? I mean, the market's so different now. We've got all this technology, information overload. Yeah, it's a whole different ballgame now. It feels like it's a million times harder to be an intelligent investor today.
It is. The landscape has definitely shifted. You're right.
Right.
But here's the thing, human nature hasn't changed that much.
Yeah. That's true.
People still get greedy. They still panic. They still buy high and sell low.
Yep, been there, done that.
And Graham's principles are all about, understanding those human tendencies, those ingrained things that we all do.
Okay.
And using them to your advantage.
So even though the actual companies and the technologies are different, the underlying psychology of the market is still the same.
Exactly. And that's why Graham's focus on value, on that margin of safety we were talking about, is arguably even more relevant today, Because when everyone's chasing the next hot stock, it's so easy to get caught up in all that hype and overpay.
Right.
And that's when those principles become your anchor. They help you stay grounded and make those rational decisions.
I like that. They're like your anchor.
Yeah.
Okay, but how do we actually apply these principles in practice today?
Yeah.
Like say I'm looking at the market right now and everything seems so expensive.
Yeah.
How do I find that margin of safety when everything's, the valuations are stretched?
Yeah, that's the $1 million question, and there's no easy answer.
Right.
But here are a few strategies to think about. Okay, first, broaden your horizons. Don't just limit yourself to those big, well-known companies that everyone's always talking about.
So like venture off the beaten path a little bit.
Exactly. Look at smaller companies, less followed industries, maybe even international markets. There are often these little pockets of value hidden in those less crowded spaces.
Interesting. So it's almost like being a contrarian then, going against that herd mentality.
In a way, yeah. It's about, doing your own research, thinking independently, and not being afraid to go against the grain a little bit.
I like that.
Another strategy is to really, really focus on those companies with strong balance sheets and, a consistent history of generating cash flow.
So companies that aren't drowning in debt and can actually pay their bills.
Exactly. Those companies, they're better equipped to weather those economic storms that inevitably come along.
Right.
And they might offer that margin of safety even if their earnings aren't super exciting right now.
So they're not the flashiest, but they're the workhorses.
Exactly. They're the steady workhorses that can provide those solid returns over time.
Right, right. Slow and steady wins the race. Okay, so it's about looking beyond those flashy headlines and focusing on those underlying fundamentals that really indicate a company's resilience and ability to create value over the long term.
Absolutely. And don't forget about patience.
Oh, right, patience. That's always the hard
It is. It is. But in a market where everything seems, overpriced,
Hmm.
it's okay to wait for those opportunities to arise. You don't have to, don't feel pressured to just buy something because everyone else is.
Yeah, that FOMO is real though, especially when you see the market going up, up, up. It's like, oh, gotta get in on that.
I get it. I get it. But remember, Mr. Market, he's always going to be there offering you those deals, those opportunities. The key is to be patient and wait for those moments when he presents a clear mispricing of value, and that's when you strike.
Okay, I like that. So instead of feeling overwhelmed by all the noise and the chaos, you're kind of in control. You're waiting for those perfect pitches to swing at.
Exactly. Exactly. And when you do find those opportunities, remember to diversify your portfolio.
Right, diversification. Another one of those golden rules.
It is. It is. And it's just as important today as it was back then, spreading your risk across different different companies, different industries, different asset classes even.
Right, right. Don't put all your eggs in one basket.
Exactly. It helps protect you from those unexpected events, and it makes sure that one bad investment isn't going to wipe out your entire portfolio.
Makes sense. So we've got the value mindset, we've got the patience, we've got the diversification.
Yeah.
Anything else, any other words of wisdom from Graham that we should keep in mind as we, navigate this crazy modern market?
One more thing. Never stop learning. The market is constantly evolving. New industries are emerging. Technologies are disrupting the status quo. And to stay ahead of the curve, you got to be a lifelong learner, constantly reading, researching, expanding your knowledge.
So even though we've learned so much from Graham today, this is just the beginning, really.
Absolutely. The Intelligent Investor, it's a book you can come back to again and again throughout your investing journey. And you'll glean you'll glean new insights each time. It's a foundation upon which you can build your own investment philosophy and your approach.
That's great. I like that. Okay, well, this has been an incredible deep dive. I feel like I've got this whole new toolkit to approach the market with more confidence and clarity.
I'm so glad to hear that. Remember that the journey to becoming an intelligent investor, it's ongoing.
It's a journey.
It's a journey. It's about constantly learning, adapting, refining your approach, and always remember Graham's core message: investing. It's not about beating the market. It's about beating your own emotions, and making those rational, informed decisions that align with your long-term goals.
I love that. Beat your own emotions. That's really what it comes down to, isn't it?
It really is.
All right, well, on that note, we'll wrap up this deep dive into the intelligent investor. We encourage all of you out there to continue exploring Graham's work and embark on your own journey to becoming a more intelligent investor. Thanks for joining us.